Good morning. It's Thursday, the 5th of December, and this is Govindraj Ethiraj, headquartered and broadcasting as well as streaming from Mumbai, India's financial capital. The top stories and themes today, there is no take, but there's a lot of conversations and very interesting ones, if I may say so myself. Now, the stock markets continue to rise, albeit steadily, and that's good news. Which way will liquidity flow in coming days between Indian and global, and what will influence markets, and what are the trends ahead? India's GDP for the second quarter came in at 5.4%. So the ball is now in the Reserve Bank of India's court to do something. But what will it do and what will work? Temperatures this winter season could be higher and that could affect crops.
This is the Core Report with Govindraj Ethiraj.
Markets still edge up. It was the fourth consecutive and successive rise in the stock markets, and while the indices were flipping back and forth during the trading day, they settled finally higher as opposed to the trend we saw last month and before, where the selling pressures would typically lead to lower levels of closing after the same amount of flip and flop. The Sensex was up 110 points at 80,956. The NSE Nifty50 was up 10 points at 24,467. HDFC Bank continued to rise, ended at a record high closing of 1,860, and its 52-week high was 1,865 during intraday trade on Wednesday. HDFC Bank alone contributed 217 points to the BSE Sensex, according to Business Standard. Broader markets outperformed the benchmarks, with the Nifty Mid-Cap 100 being higher by about 1%, and the Nifty Small-Cap 100 also higher, but a little less than 1%. And across the Atlantic on Wall Street, stock futures rose on Wednesday as Salesforce and Marvell Technology led tech shares higher thanks to strong quarterly earnings. Futures linked to the Dow Jones Industrial Average, S&P and Nasdaq were all up. Salesforce was up 13% after it posted fiscal third quarter revenue that beat estimates, according to CNBC. And chipmaker Marvell also beat expectations. So December has started a little more slowly compared to last month, but the rally could pick up is what analysts are telling CNBC. This is on Wall Street. India, of course, as we've discussed, has had a better December start than November, of course, and that's at least so far. Wall Street generally has good Decembers. What are the flows telling us? The Indian equity markets are poised at an interesting place. For one, they've recovered from the lows of last month. Second, domestic flows are looking stronger as selling by institutional investors has slowed down, so the counterbalancing force is strong. So how are the forces of demand and supply playing out right now, and what lies ahead from a fundamental and technical point of view as we look ahead? And also, how was 2024 from an overall stock, theme, liquidity and valuation perspective? And valuation, of course, is very critical to finally deciding what makes sense when it comes to buying in these markets. I spoke with Vijai, Mantri, co-founder and chief investment strategist at Mumbai-based asset manager JRL Money, and I began by asking him to walk us through the demand and supply forces as he was seeing them.
So I think the importance of FII is year after year is actually going down. Actually, the sales is making it much more acute. So for instance, today, DII and FI holding is almost identical. The second thing to keep in mind is that in 2008, when FIS sold $15 billion of Indian equities, the market corrected 60% because at that time, total market cap of Indian equity was $1 trillion only. Right now, FIS sold almost similar kind of money, but since the market is $5 trillion, the impact is coming down. And increasingly, I'll see the impact of FI actually going down. As far as domestic flows are concerned, it's just not limited to mutual fund. There's a NPS, there's a EPFO money, which is, I think, 4,000 to 5,000 crore. Pretty long-term money, and that money only goes into Nifty or Sensex companies. And NPS now is part of money goes into BSE 200 stocks. So at the top end of the market, no challenges. Inflows are pretty huge. And many times when we look at SIP number, which is 26,000 crore, add NPS money, add an EPFO money, and then forget about the insurance altogether. And then we have a huge amount of asset in AIF and PMS. So all put together, easily we get 50,000 crore inflow on 40 to 50,000 crore inflow on monthly basis. So easily we can take $4 to $5 billion of foreign outgo every month. So weekly, if they sell $1 billion, absolutely no problem. And on the contrary, domestic investors are waiting for the opportunity to whenever somebody sells. So we have seen a very mature behavior from the retail investor.
I mean, you talked about a lot of the specialized funds, including alternate investment funds and portfolio management schemes. But many of them too are, by virtue of being, let's say, smart investors, would also be taking out and selling into high valued or markets which are valued highly, as we've seen recently, isn't it?
Actually, anybody who's done and sold India actually regretting. Any portfolio manager who took the cash call. I remember one who somebody last year took 30% cash call. Now the challenges with that kind of strategy is that if you have 30% cash and 70% on invested in equities, you always wish 30% call should go right. And invariably, we have seen anybody who took a cash call has not played out. So a smart money is actually not sitting. And what a smart fund manager has done is that they have this balance advantage fund and those kind of funds. So cash call they take in these kind of fund, not on the frontline funds at all.
So how do you see that playing out right now? I mean, if we were to now come to where we are in the markets, having recovered maybe about 2.5% from the bottom, where are we?
So if you ask me from a valuation perspective, from a optic and from a traditional perspective, it look little stretched and expensive. But why it is looking stretched and is for very simple reason that post COVID we have seen a different kind of market. But just look at the corporate profitability in 2011. It was 3,99,000 crore of all listed company, and India's GDP was 78 lakh crore. From 78 lakh crore in 2010, COVID had become 210 lakh crore. So almost 3 times growth. But the corporate profit has moved from 399 to 455 only. So we call 2010 to 20 is a lost decade of Indian equity. From that, the corporate profitability from 455 has moved to more than 15 lakh crore. So what we are seeing right now is a catching up of the corporate profitability of what we have seen from 2010 to 2020. So that is a one way to look at it. Second way to look at it is that we have seen the technology is making Indian economy more and more formal. So if you look at mobile phone, and because of mobile phone, we are buying everything online. Most of things. So earlier, typical household expenses only 10%, 20% which goes to formal economy. Today, large amount of spending happening on the mobile phone. So that is the reason you see huge GST collection, you see corporate profitability much better way. If you look at just one data point, India import 850 tons of gold every year, and that is 7 lakh crore. And let's assume only 60% or 70% those goes into manufacturing jewelry. In year 2000, the share of organized player was only 5%. In 2024, it has become 36%, and every quarter it is increasing. So what we are saying, the spending which all of us used to do, perhaps part of that was large, not part of corporate earning, organized corporate earning. That trend is very, very visible. And second thing, with rising per capita income, the premiumization of Indian economy is actually happening. I don't know whether you saw it today or not. Taj Land Sand, 1,83,000 is the price today. That is aberration. And so we have been communicating consistently to investors that we don't see any big correction in the market.
Right. And yet, on the other hand, if valuations are high, which you've said they are at this point of time at least, that would obviously cause a lot of fund managers, whether it's domestic or international, to keep selling. So, where does that technically leave the market then? At least again at this point of time, because I understand that we are constantly seeing inflows of 40 to 50,000 crores a month, which is good. But if I'm investing in the market, I'm only investing it so that someone can get out, isn't it?
So what is happening is that they're changing because every 2-3 years there's a new hero emerges in the market. So a couple of years back it was FMCGs and power and all that. Now we have pharmaceutical consumptions and all these kind of things. So this is what is happening. The fund manager's job is to keep changing the portfolio on the basis of what they see. So for instance, if you look at Nifty 50's earning growth, there are 22 stock which delivered less than 10% earning, but there are 22 stock which deliver more than 10% earning. So it's just not that there's no earning growth, and there are always a pocket. Definitely there's a fact that in the small and mid cap we are seeing huge challenges, but in large cap space we don't see big challenges because we are seeing robust earning growth in certain pockets. Whatever earning growth challenges we are seeing is more on the energy and metals, and most of them actually are input for the industries. Beyond that, we are not seeing big challenges. So from these level, I don't think the market's a big correction, but the return expectation has to be more reasonable going forward from these levels.
So you talked about the hero. So hero, obviously, for example, was consumer products or FMCG companies, which is not the case now. IT was the hero. It lost out for a couple of years. There seems to be some slight revival in their fortunes. I'm talking about stock prices now. Company also maybe things are looking up a little bit, but yet not fully. What are the big heroes that you're seeing right now, and either new or old?
If the Indian economy is continue to get formalized, and BFSI is a space one could look at. The second space is healthcare, which is definitely we are seeing great signs. And consumption. So is very honestly, consumption is not FMCG. FMCG have their own challenges because how many times you're going to brush your teeth or eat Maggies, or how many times you're going to hair or shampoo in a day. But what is happening? Alcohol is a consumption, jewelry is a consumption, travel is a consumption, and certain medical product has become consumption. So consumption scheme actually is much wider. The building material products are consumption item. So if consumption has to be seen from a traditional FMCG ways, I'm afraid that is not the way to look at it, and that is not the way we look at it. And many times we hear people saying rural demand, the rural about the stress. But the point to keep in mind is that in last couple of years, there were 3 crore houses built in rural India and Pradhan Mantri Awas Yojana. So what the guy will do, he will pay toward his house or will buy more Maggies or shampoo. So what you see very interestingly is that the wire and switches manufacturing companies' prices has gone up because we are seeing sales there. So that is what we keep looking. Where is the needle moving? And very honestly, consumption is a big mega theme over the next 10, 20 years. We're seeing huge mega theme in healthcare and BFSI 3 sector. And definitely China plus one policy is actually working on ground. So these are 4 sectors we are looking at least for next couple of years and perhaps much longer.
When you say China plus one, I mean, the government itself doesn't seem so confident about China plus one. But are you referring specifically to PLI-linked manufacturing expansion or something else?
Yeah, absolutely. If you look at, for instance, auto ancillaries, we used to import $1 billion of auto ancillary product. Now, that number has almost become zero. If you look at electronic items, we are getting almost self-sufficient. Even if you look at pharmaceutical. See, we need to keep in mind that China is light year ahead of us. So catching up will take time, but the wind is very clearly blowing in that direction. If you talk to people, you get to hear that they are getting inquiries. And what is happening is that, for instance, Vietnam, the Foxconn is telling Vietnam to reduce electricity consumption. So many of these tiny countries became a sort of a supply center. There are challenges. And for instance, last year, Mexico replaced the biggest trading partner for USA. But Mexico, most of the money is from Chinese companies. So in Bangladesh, you see the similar kind of thing. So Chinese money is being. So now if you see what will happen. And when we talk about ease of doing business and all that, please keep in mind that India is not a country where they will put a red carpet in form of all the concession you wanted. Today, Vietnam, Samsung contribute 28% of Vietnam GDP. I don't think India will allow that luxury to any company. So doing business is like living in India is going to be very tough, but the growth is here only.
Right. Last question, Vijay. So 24 is coming to an end. How do you look back at the year and how do you contrast this year from a market's point of view? I know there are some very unusual moments when you look back in your own sort of experience and history.
So I think 2023, 24, I think all of us said that bada paisa nahi banega, nobody big money will be made, but market actually surprised all of us. You speak to any good fund manager in India, they've been extremely cautious about a small cap. But a small cap has delivered the highest return. And even in this selling, the correction in small cap has been very minimal compared to large cap. And very interestingly, if you look at factor-based investing, the high quality, low volatility indices, actually they have done worse, which is very strange because what was considered to be the high quality in previous market cycle perhaps will not be high quality going forward. So we are seeing Indian market at inflection point. We are seeing Indian economic inflection point. And the way we need to look at the market in past, I think we need to change that mindset going forward. And we have seen every bull market, knocks off few old bulls. And this market is not going to be very different. We have to be very, very, very honest. We have to be really paranoid.
That's a very good note to end on. Vijay, thank you so much for joining me.
My pleasure.
Will the Reserve Bank of India cut interest rates? GDP growth for the second quarter of the current financial year came in at 5.4% year-on-year last week, and growth during the first half of the whole year, that's again 24-25, the financial year, is now at 6%. All these figures have evidently surprised and even shocked some members of the economist community. On the other hand, inflation, thanks to food inflation, is high at 6.2%. So overall growth for the current year would thus come in at about 6% below the Reserve Bank of India's projection for 7.2%. Speaking of the Reserve Bank of India, the question many are asking is whether the central bank will cut interest rates and whether the next Monetary Policy Committee or MPC meeting that started yesterday will reveal its decision on Friday or tomorrow will lead to an interest rate cut. Whatever the decision is, it's useful to look at a background. The larger question to be posed before asking if the Reserve Bank of India should cut interest rates is whether such a move would help, whether help right now or help accelerate things along. And then should the Reserve Bank of India do something else, for instance, focusing on increasing liquidity? I reached out to Garima Kapoor, Chief Economist and Executive Vice President at Elara Securities, and I began by asking her how things stood in the context of these slowing GDP numbers that we'd seen and what she was prescribing and looking ahead from the Reserve Bank's actions in coming days.
The number really was below not even consensus expectation, but far below RBI's own estimate. Recollect, RBI was sitting at 7% for Q2. 7% was for the quarter two, and they had revised that number downwards to 6.7. So from 6.7, the number actually came at 5.4. There were certain idiosyncratic factors that drove the number exceptionally lower, but even if I remove the impact of that, the GDP would not have been more than 6% in any case. That means we are probably staring at a significant slowdown because capex is not picking up and the spending momentum is clearly slacking. Not just urban, but I think rural momentum also is something that is not picked up very materially as RBI expected. Now, can RBI cut rates? The billion-dollar question. Remember, we have the same governor who until about a couple of weeks ago in some of the public presentations and public appearances was still very concerned about headline inflation because of food and was concerned about the fact that there was no slowdown and growth was fine and probably they would just see a small patch of a probably aberration of 20-30 basis point lower. Now, for such an RBI to be able to cut rates, of course, becomes a question of whom do you trust and what's the credibility of a central banker left? Now, that leads into that question, what can the RBI do? RBI has to do something. Remember the last policy, they've already revised their stance on liquidity to neutral from withdrawal of accommodation. So in my estimate, the best thing for them to do would be CRR cut. Now, the reasons for CRR cut can be multifold. One, of course, is the fact that it's a signal more than anything else. Number two, when your currency is downward spiral, you rather not play a lot with, let's say, rate cuts rather than give a signal through liquidity. Number three is your durable liquidity is going to enter into a deficit zone in quarter four of the current financial year. So it needs that purpose as well. So I would say if a central banker were to take a decision, a CRR cut of 25 basis point staggered 2 times, 15 days apart, or a 50 basis point would be a much better policy response to the slowdown than a rate cut.
You're saying that if we were to cut interest rates at a time when the currency is also depreciating against the dollar, that is a problem. So can you explain both these situations for those who perhaps may not understand?
Sure. So currently India is overvalued on real effective exchange rate basis. So clearly one of the angles that we need to take into account is the fact that there is a downward pressure on the rupee, number one. Number two, RBI is sitting short in the forwards market to a tune of about $60-65 billion. So should RBI decide to take deliveries of those forwards, then it will suck out further rupee liquidity from the banking system. So in that context, CRR cut will probably be a better measure. The third thing is that the CRR cut would help because in the current situation that we are in the probable tightness of liquidity, even if you cut interest rates by 25 basis points, the banks are not going to be in any position to pass it on because they see liquidity tightness in the foreseeable future. So it is going to be a futile cut. Although signaling might work, the cut is not going to get passed on or transmitted as quickly as one would have imagined in a normal situation. So hence, the normal action would be to first ease the liquidity in the banking system, so it becomes a signal. Prepare for the quarter four tightness, which anyway the liquidity gets drained out aggressively because of seasonal factors. Prepare for a possible response on the currency if RBI decides to take the delivery in the forward market. And fourth, make sure that banks have comfortable liquidity for them to then pass on the rates as and when they have cut.
So all of this, it does not seem to be addressing the problem here, which is the slowdown in the economy, or does it?
See, the slowdown in the economy can be looked at in two ways. One, it's partly policy triggered because government spending was significantly slow. It's 14% degrowing April to October this year. And at the same time, RBI took multiple macroprudential decisions relating to credit. It started off from personal loans, went into loan against property and microfinance, and then probably some other a new component would be under RBI surveillance. So, in that context, when your policy triggers are something that are outside the purview of the consumer who's looking to see an interest rate cut, will the rate cut immediately help spur demand? Because you're trying to control the excesses in the system by reducing the excesses built in the credit economy, and at the same time, government is not spending. So, will this spur immediate demand? Maybe not. So, it might not be a wise decision, hence, to right now cut. A cut is welcome, of course, at any given point in time, but the cut would be more meaningful or productive if it is backed by a measure to ease liquidity, is what I'm trying to put across, especially when the slowdown is driven by multitude of factors, including policy, which is exogenous.
Got it. So in a macro way, that interest rates do not really, at least in the short to medium term, determine businesses spending more or expansions or things they would do which they would because they had access to easier money or cheaper money. Like what you're saying seems to suggest that there's no direct linkage or it's a staggered linkage at best.
It's a staggered linkage. So, our monetary policy takes about 2 to 3 quarters for the transmission to play through the economy. And given that India is in perfectum of the economy, given that relatively high presence of cash still in the economy, although we're getting digitized, it probably transmits with a lag. Now, having said that, also remember there is a part of portfolio, especially your portfolio, which is linked to your policy rate, because you do have an external benchmark rated portfolios for banks. That portfolio gets repriced immediately. So at best, that portfolio is sitting at 35 to 40% of your total loan book. But when we talk about businesses' desire to invest, remember in a backdrop when economy is slowing and the demand is weakening, it is the business outlook that will drive greater optimism for capex rather than rate cuts.
And clearly, we are not seeing enough of that. So, one is consumer demand, which you say has been throttled to some extent by the Reserve Bank itself tightening risk weightages and so on non-bank finance companies, for example. I mean, that's one part of the demand pie. The other is companies who are also sitting on so much cash that they may not need so much money to borrow, and therefore the interest rate doesn't really matter beyond a point. So, what is then maybe the trigger that the economy could use to, let's say, get a leg up or a kick up at this point of time? I mean, it's not that it's not growing, but to grow faster.
See, the immediate kick-up would be government starts to increase its momentum of spending, which we're already seeing. So maybe the October numbers that will come out end of this month will show you the things that picked up. The order awarding activity of the government is also picked up. You're seeing that in defense, and particularly when 22,000 crore worth of indigenization orders were approved last evening. Number 3 would be basically to accelerate the pace of revenue spending, because government revenue spending tends to be the biggest bucket that drives the economy. And number 4, to some extent, would be, I think, RBI taking somewhat a little less aggressive stance in some of the rules or the, I should say, provisions that they made. For example, project financing draft guidelines were out, which indicated there could be a significant increase in cost for the project financiers. Now, if RBI were to review that guidelines, instead of basically imposing the proposed range of about 2% or 3%, it could tone it down to about 1% or 1.5%, or depending upon the size of the project. So I think both ways is the best way to work. I think policy rate decisions, particularly lower interest rates, will start to work very effectively so as in when the liquidating the system normalizes.
Right. And that comes back to your original point as well. Garima, thank you so much for joining me.
Thank you, Govind. Thank you for having me.
India faces higher temperatures. India is likely to see above average temperatures during the winter season, the government's Weather Bureau, that's the Indian Meteorological Department, said earlier this week, raising concerns about the yields of crops such as wheat and rapeseed, according to Reuters. India is expected to experience above normal minimum and maximum temperatures from December to February, with fewer cold wave days expected, the India Meteorological Department said in that statement, which was reported by Reuters. So, what happens is that winter-sown crops such as wheat, rapeseed, and chickpea are planted from October to December and need cold weather during their growth and maturity stages for optimal yields. So, lower production could force the country, which is also the world's largest wheat producer after China, to import the staple to ensure affordable supplies and also to increase imports of pulses and edible oils. So far, India has not imported wheat despite the high prices here. Hot and unseasonably warm weather has hit India's wheat output in 22 and 23, which led to a sharp drawdown in the government's reserves, according to Reuters. Meanwhile, to bring down prices by boosting supplies, the government plans to sell about 2.5 million metric tons of wheat from its reserves to bulk consumers such as flour millers and biscuit makers, says Reuters. Meanwhile, a deputy governor of the Reserve Bank of India said on Wednesday that climate change has a bearing on both price and financial stability, and there is a need for a regulatory response to mitigate risks arising out of it. The impact on the financial system and economy, according to M. Rajeshwara Rao of the Reserve Bank of India, arising from climate change is dependent on the extent of their exposures to these risks and mitigation measures that are in place, he said, pointing out that the dilemma and challenge placed by regulators is not to only put in place an enabling ecosystem from a prudential point of view, but also act as an enabler and facilitator for orderly and sustainable development of the financial system and economy. Hence, he said, the mitigation of climate change risks not only requires individual sectoral response from regulators, but also inter-regulatory coordination. So, according to him, the Reserve Bank has been proactive to mitigate climate change risks that may impact the financial system by setting up a dedicated group within banks to assess climate change risks and foster a robust ecosystem for sustainable finance. Additionally, the Reserve Bank of India has conducted a survey on climate risk and sustainable finance covering about 34 scheduled commercial banks, and following this, it released a discussion paper on climate risk and sustainable finance along with a framework on green deposits. And some parts of this we've discussed here before. That was the core report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.